Your reading for this week discussed value-based management. It talked about management decisions falling into 3 different categories. The first being operating, such as what products will we produce. For your small business case study for this week, you've asked yourself that exact question. Investing decisions are the next category, and those will include things such as where should we build a plant. Financing decisions are the third category, including things such as how will we fund our operations. Now, each decision has a different impact on a business, and each decision will ultimately increase or decrease value. Operating decisions will impact things such as sales growth, operating profits, and income taxes. For instance, should we run a promotion to increase sales? That's a management decision that would impact sales growth, which would in turn impact the value of the business. Can we get a lower price for raw materials if we change suppliers? That's another decision that managers need to make, and that could impact operating profits, which then in turn impact the value of the business. What tax breaks can we get this year? That's another example of a management decision that would impact income taxes or the operations of the company, which ultimately will impact the value. The investing category includes decisions that will impact working capital requirements and the fixed asset capital that's needed. For example, what payment terms do we need to offer our customers? The different payment terms would impact the amount of accounts receivable we would hold. Fixed asset capital decisions might include how many machines do we need to buy to keep up with demand. The final category, financing decisions, will impact things such as how much debt or how much equity do I need. For example, should we borrow from a bank? What interest rate are they going to charge me today? Or should we sell stock? How much in dividends will we need to pay if we do that? Operating and investing decisions should result in profit. Now, an individual operating or investing decision might result in a loss, but overall, for a business to survive, the net sum of the operating and investing decisions should result in profit. Financing decisions regarding the capital requirements of a company result in cost. If you think about debt and equity, funding those is not free. That's at a cost to a company. Now, when the profit exceeds the cost, that's when shareholder value is created. That's ideally what every business wants to see. And the time period over which this occurs is called the value growth duration. Now, shareholder value can be in the form of dividends or in the form of capital growth. By capital growth, we mean the increase in the market value of the stock. Now, management should employ strategies that provide long-term value creation as well as short-term, and that's why it's important to look at the value growth duration. When we think about strategies, what's the purpose? Managers are there to pursue profit over the long term, and so they're instilling strategies that will help them do that. This requires setting and measuring performance targets. Management will never know if they're following their strategy if they don't set targets and then measure against those to see how they're doing. And ultimately, managerial accounting provides the information for management to set and measure those performance targets. That's ultimately the purpose of managerial accounting today.